Happy to do this and happy to be here. And again, I want to welcome you on behalf of OASIS to today's webinar. OASIS is presenting, topic being RRSPs and TFSAs. And as Brent introduced myself, my name is Roland Chiwatalu. I am a financial wellness consultant with Eckler. Just a reminder that OASIS selected Eckler to collaborate on providing this support to OASIS members. Eckler is independent from OASIS. We are financial wellness experts. We work with similar organizations across the country where we develop and deliver these types of programs to employee groups all across the country. So a few housekeeping items. We have until the end of the hour. So we're starting at 11 a.m. Eastern Standard Time, as I'm here in Toronto. And so we're scheduled to go until noon. And the way we kind of want to break it up, because we do want to allow time for questions, if there are any, is that we want to start with the presentation, go through the content, and then address questions at the end. But do feel free to use the Q&A button that you see there on your screen. If you want to answer a question, just hit the Q&A button, and then you can go ahead and type in your question as it comes to you. And that way it will be in the queue, and then I'll take a look at all the questions that we have sitting in the Q&A at the end of our session. This webinar is being recorded, and it will be posted up on the resources section of the OASIS website. I would say probably by this time next week. You can look out for it there, and then you'll always be able to access the content via the recording on the OASIS website from there on. So this is our agenda. We want to talk about, as Brent mentioned, we want to talk about how income taxes work, because income taxes is such a big aspect of the two types of registered savings plans that we're going to be talking about today, which are RSPs and TFSAs. So we'll talk a little bit about income taxes, and then go into each of the two accounts to describe their features and use cases. We want to talk a little bit about a couple items, including beneficiary elections. Creditor protection is another thing that we're going to talk about. So some investment and tax planning that you might want to consider, specifically with the tax-free savings account. And then we'll wrap up by talking about, when might be the optimum time to use each. I think as a financial planner, I would default, if you have the means and the capabilities and the ability to do it, to maximize both. But if you can't maximize both, then we can talk about what are the situations and circumstances where you might want to consider one over the other. So I think it's important to assess the difference between the RSP and TFSA, and to do that, you need to understand the role that income taxes play. And it's been said that in this world, nothing can be said to be certain except death and taxes, and that's from Benjamin Franklin. And I think it's important to remember that you always have to think about taxes when it comes to financial planning decisions that you're going to be making. And certainly, saving in an RSP or TFSA, tax comes into play in part of your calculus and your consideration in how you do this. So you want to think about that. And if you haven't paid on tax on it yet, it's not that you're not going to pay tax on it ever, but you'll probably end up paying tax on it. And certainly this is going to be a point of consideration with regards to RSPs and TFSAs. Which one does the tax deferral, meaning that you pay tax on it later, not now, play a role, and which one the tax-free, which means when you take money out, it's tax-free, you never pay tax on it, and how does that figure into your calculation and which account you want to prioritize? So let's start with our first poll, just to get a little bit of engagement going. And the question of the day is, if you are making $80,000 a year and you happen to live in Ontario, so we're just going to use Ontario for this example, and what do you think your average tax rate is going to be on $80,000 a year of income living in Ontario? So we're combining the federal and the provincial tax rates in here. So thinking about sort of your total income tax situation to the feds and to the province of Ontario, what do you think your effective or your average tax rate is if you make 80K? So we have about more than half of you by now have participated in the poll. And so let's end it and see what the results are. Share the results. It looks like half of you picked 25%, and the 40% went with 31%, and 1% picked the 43% tax rate. So 25% tax rate, quick math, that would mean on $80,000, you'd be paying $20,000 in taxes, and you'd have about $60,000 left over. That kind of sounds, reasonable, but in fact, that is a little too high. It's a little too high. The correct answer is actually 21%. So that's interesting, right? 21% is basically the average or effective tax rate that you'd be paying if you made $80,000 a year and you happen to live in Ontario. And so, okay, let's take a look at that, because I wanted to warm you up to really talk about this topic here, which is the difference between your average tax rate. So kind of what we were doing in the poll. If you have your yearly salary, then we take a look at what you have to pay in taxes. So we divide those two, we'll get your average tax rate. And I'm telling you that if you make 80K, 21% is going to be your average tax rate in Ontario. But the way our income tax system works in this country is that we have a progressive income tax system, which is to say that as you earn more and more dollars throughout the year, you're actually taxed at progressively higher rates of marginal tax rate as your income goes up and up and up, and you start to go from one tax bracket to another tax bracket above to another tax bracket above. You jump in these marginal tax rates. And so what the marginal tax rate is the tax rate that we're taxing chunks of your income within certain brackets. That's what the marginal tax rate is. But when we add up all of your total tax that you have to pay and divide it by your income, we get your average tax rate. And they're not quite the same thing. One reason is that, for one, the first sort of income bracket you start the year off in, you don't pay any taxes at all until you make more than what we call the basic amount. And so example here is what we're showing you is again, using Ontario and the Fed combined tax rates and income tax bracket regime for 2022. The federal basic amount is around $14,000. So you don't start to pay federal income tax until you make more than that. Then there's a provincial basic amount, which every province has a different amount there. So let's just say, you need to make over 14,000 if you are an Ontario resident before you start actually paying any tax. So that first marginal tax rate is 0%. Then basically that means the effective tax rate is also 0%. If you happen to make exactly 14K in the year, because you're not paying any taxes. So 0% on the marginal side, 0% on the effective side. But as you make one extra dollar, now you're into the next tax bracket. And the marginal tax rate for that next chunk, so you can see it's about $30,000 of income that we're talking about, is roughly 20%. So that 30K gets taxed at 20%. And now what we have is a difference with the marginal tax rate and the effective tax rate for someone who makes about $46,000, because you have to take a look at the impact of the first marginal tax rate at 0% because of the basic amount. Then you get to the next chunk, which is taxed at 20%. So the combination of those two, if you make exactly 46K, your average tax rate is actually 14%, even though when we're looking at your marginal tax rate at 46K, you're being taxed at 20%. So here's what we're actually looking at here is that the marginal tax rate just tells us as you earn more and more dollars and you jump tax brackets, what the next highest dollar you're going to make, how much you have to pay in terms of taxes. But when we look at your overall tax picture throughout the year, divided by your income, your average tax rate is always going to be less than the marginal tax rate at your highest amount of income for the year. And so here's where we use that example of 80K. You can see 21% is the effective tax rate. even though at 80K, you're in that 30% marginal tax rate, and so on and so forth. But we do want to still understand marginal tax rates, because now you're going to see the role it plays when we start to look at the RRSP. And again, tax forms the basis of understanding the two savings plans, because they're both registered savings plans and they have unique tax features. Starting with the RRSP, your contributions into an RRSP are limited. They are limited by a formula, and we're going to look at it in a little bit more detail in the next slide. But essentially, the formula says, 18% of any money that you're earning, so wages, for example, salary, bonuses, that type of thing would be considered earned income. So 18% of that, up to a limit, because every year there's a limit. That's how much new RRSP room you create. And you can take that amount, put it in your RRSP. Once you do that, you get a tax deduction. So here's our first tax feature, a tax deduction. When you put money in your RRSP, it actually reduces your income tax situation because you get a tax deduction. Once your money is inside of an RRSP, so use the analogy of a box that we're showing you on the slide. So the box is the RRSP, you put your money in that box. Once your money is in that box, you can start to invest it however you like. You can buy stocks, you can buy bonds, you can buy mutual funds, you can buy GICs at the bank. You can hold it in cash in your RRSP if you want to. But any growth you get based on the investment performance while your money is in your RRSP, while your money is in the RRSP box and the investment is growing that money, that is otherwise taxable income. But while it's inside of your RRSP, you're not paying tax on the growth. So we call that a tax deferral. Your growth is tax deferred. When do you actually pay the tax? Because it's only deferred, it's not eliminated. It's deferred until when you take the money out. You take the money out, and then you have to pay tax on everything you've taken out. Whatever you withdraw from the RRSP, all of that is taxable, and so it creates taxable income. So I mentioned that you have a limited amount of contribution room, and we talked about 18% of your gross income, the earned income in the previous year. That creates your new RRSP room. However, if you have a participate in a workplace pension, then that's going to reduce the new RRSP room you've created by that formula, and we call that a pension adjustment. So anytime you're part of a pension, you're going to have a reduction in a new RRSP room you can create because of your pension adjustment. And so that becomes your RRSP room for that year. 18% of your previous year's earned income minus the pension adjustment equals your new RRSP room for the year. Add to this, though, any unused RRSP contribution room that you have from the past that you haven't used up. And then you have your total RRSP room, which you can use to contribute into an RRSP, or you can open up a spousal RRSP if you want, if you have a spouse and you want to do future income splitting. And so you can contribute up to your total room without going over it. If you do go over it, you're going to have to pay a penalty until you remove the over contribution. So that's why it's important to be on track and on top of your total RRSP room. You can do that by taking a look at your notice of assessment. When you file your income tax return and you get your notice of assessment back from the government, from the Canada Revenue Agency, it will show you your total RRSP room and how it's calculated. So now that we understand a little bit more about the income tax situation and the rules around the RRSP, now we want to understand, well, why would you want to contribute to an RRSP? How does it impact you and benefit you? Well, here's the logic behind using an RRSP. When you have higher income, usually during your working years, so we tend to go through different levels of earnings. When you're young and you're a student, you're in school, you're not making much money, your income is nil if you're not working at all, or low if you're working part-time. And then you get into the workforce and you start to make more money. Maybe you're getting established in your role and you're starting to earn more and more and more. And then usually what we see happen is that you retire and your income goes down a little bit more. And so your sort of peak earning years are going to be during that period of time when you're in your sort of mid to late career. And that is the sort of best time to really contribute to an RRSP, because when your income is higher, you put money in the RRSP, you get a tax deduction for every time you put money in an RSP. So in this example, let's say you're at $80,000 of taxable income. And again, we're using Ontario in our example. And so remember, the marginal tax rate, this is why it's important to understand the marginal tax rate, because it's going to help us understand the value of the tax deduction that you get. So look at this example. $80,000 in taxable income, you put 10K in an RSP. That 10K in an RSP reduces your taxable income. That's what the tax deduction does. It reduces your taxable income. So now you're at 70K of taxable income. And that reduction, that $10,000 reduction of taxable income, all happens to be taking place in that 30% marginal tax rate. So that's how we calculate the tax deduction worth of $3,000. So it's $10,000 of taxable income that you've gone down, all of them in that 30% marginal tax rate. So 10,000 times 0.3, $3,000 tax deduction, which can be a refund, right? That can be a refund. And what you really want to do and take the full advantage of saving this way is when you get your refund, save that refund. And this is not just about RSPs, this is just in general. Like if you get a tax refund, and normally you get a tax refund every year, if that's the case for you, what are you doing with that tax refund? Because this is an opportunity to really accelerate your financial planning. This is a real golden opportunity to get you closer to your goals and achieving them faster. And so if your goal is to save, well, when you get a tax refund, save it. Save it in an RSP or in a TFSA. Or if your goal is to save for a down payment, then you use that to save for a down payment. If you're mostly focused on paying down debt, use the RSP, the tax refund that you're getting, and use it to pay down debt. So that's the idea, is that you want to use those opportunities to get you and accelerate you towards meeting your goals. I know the temptation for a lot of us is to spend that money. And I think you do want to, have some balance, enjoy and have some fun, but don't spend all of it. That's hopefully what I'm trying to impart on you. Use a chunk of it, most of it, or all of it to help you get towards your financial goals a little bit faster. All right, so tax deduction, $3,000. Now what happens when you take the money out? And so I mentioned you might want to take the money out when your income is lower. Typically that's retirement. So at retirement time, you want to start to use the RSP to supplement your retirement income. And so let's say you have $30,000 of taxable retirement income, and then you take an additional 10K out of your RSP. And so that RSP withdrawal is going to push your taxable income up to $40,000. And in this case, it's pushed it up in terms of tax by about $2,000, right? Because it increased your, it added to your taxable income in that 20% marginal tax rate. So basically added your tax owing to about by $2,000. So if we look at this whole scenario, you got tax deductions or tax savings of $3,000 when you contributed, and then you had a taxable income event of $2,000 when you withdrawed it. And so you're better overall by $1,000 in tax savings. That's the sort of logic of an RSP, right? Is that when you contribute when your income is highest, the value of that tax deduction should trump the amount of taxes you're going to end up owing on it when you take the money out. If that's your case, if that's how it works out for you, then the RSP has been beneficial to you. So what about in retirement time? How do you actually, withdraw or take money out of your RSP? Well, you can convert your RSP to an income fund called the RIF, the Registered Retirement Income Fund. It's basically like the reverse of an RSP. Once you've converted your RSP to a RIF, you can't put money in anymore. You only can take money out. And you can convert your RSP to a RIF anytime. But you have to, because the last year that you can have an RSP account is the year you turn 71. You can't have an RSP after that year. So you do have to figure out what you're going to do. Either you're going to, just withdraw all the money out of your account, or you can convert it to a RIF. but the last year you can have an RSP is the year you turn 71. The RIF is designed to help you take money out of your RSP. And of course, anytime you take money out, you're paying tax. There are minimum annual withdrawals that you must make from the RIF. And so you can open this account up with any financial institution. And working with your financial institution, you will set the minimum amount that must be withdrawn. And you can decide to have it come out in weekly chunks, bi-weekly chunks, monthly chunks, or just a one-time lump sum withdrawal. It doesn't really matter, it's up to you. And you'll figure this out with your financial institution, but you have to take the minimum amount out by the end of the year. If you don't take it out, let's say you took out something less than what the minimum was for that year, because every year that you're a year older on January 1st, the minimum withdrawal for that year gets a little bit higher. The percentage that you have to take out, that's the minimum, gets a little bit higher. And so if you don't take out the minimum, then what happens is the leftover portion that you needed to take out to satisfy that minimum withdrawal will be included on your tax return as taxable income anyway. So that's how they get you. One way or the other, you have to take out that minimum so that you pay tax. And if you don't take it out, well, you're going to still end up paying the tax. So you might as well take it out. You will figure all this out with your financial institution. You can take more than the minimum, though. That's the thing. You can take more than the minimum out. You can take all of it out in any given year if you want to, out of your RIF that was converted RSP money. A couple ways that you can access money from your RSP without paying tax. Number one is the home buyer's plan. First-time home buyer's plan. So it allows you, it's essentially like you're taking a loan out of your RSP because it allows you to access up to $35,000 from your RSP towards the down payment on a home. But to qualify for this, you must be qualified as a first-time home buyer. And the definition of a first-time home buyer is someone who has not owned or occupied a home that is your principal residence that you have been living in at any time within the past 4 years. Either this is yours or your spouse's house that you're living in. If that's the case, then you won't qualify as a first-time home buyer unless you have not occupied a home that you or your spouse have owned in any of the 4 preceding years. Then you can qualify as a first-time home buyer. Take out up to $35,000, and it's per person. So if you do have a spouse or a partner, they can also take out $35K, and so you can have a potential of $70,000 removed towards the down payment of a home. But it's like a loan because you do have to pay it back. It's an interest-free loan, though. There's no interest. You just have to make these payments back into your RSP, and you have 15 years to pay it back, starting in the second year after you took the money out. If you don't make that payment, that amount is allocated as income in that year. So the only thing that can waive the 4-year, not living or occupying in a home that you or your spouse owned is if you are building or buying a home for a relative that is disabled. Then they waive that 4-year, not living in a home that you owned or your spouse owned. That's waived. All right, so that's the home buyer's plan. The other plan where you can take money out of your RSP without having to pay tax, again, it's like an interest-free loan that you have to pay back into the RSP, is the lifelong learning plan. And this is to pay for full-time training or education for you or a spouse or partner. So in this case, you can take up to $20,000 maximum, $10,000 a year. And then you have 10 years to pay this back. And the payments have to start by the 5th year after the withdrawal was made. Okay, so that's RSP. Let's look at tax-free savings account. With the tax-free savings account, you also have an annual limit that you can contribute to, and it's $6,000 for this year, 2022. However, since the TFSA was introduced in 2009, if you were eligible to contribute back then and you haven't, you've actually accumulated a total of $81,500 in total contribution room this year. So similar to the RSP, your annual contribution room in years past, if you don't use it, it carries forward. You don't lose it. But unlike the RSP, the TFSA continues for life. You get this for life, whereas the RSP, age 71 is the last year you can have an RSP. With the TFSA, you continue to have it and you continue to accumulate RSP room until, of course, and unless they change the rules. And you don't get a tax deduction when you put money in the TFSA. So basically, you're taking money that's you've already paid tax on because you get paid and then you pay taxes. And so you're taking after-tax money, putting in a TFSA. You don't get an offsetting tax deduction like you do with the RSP. So what the heck is the value of the TFSA? Well, here's the first misnomer about the TFSA. Because the name says tax-free savings account, many people think that, well, you're just getting an interest payment from the bank. It's a savings account at the bank, which is like a high interest savings account. So you might think, well, why should I use a TFSA wherein I have a high interest savings account? So that's the first sort of misunderstood aspect of the TFSA. Yes, you can just treat it like a savings account where all you're earning is interest from the bank, but that's not all you can do with the TFSA. You can open up the TFSA, a type of TFSA that lets you buy and sell stock, for example, or mutual funds. So you would just have to open up a stock trading TFSA, and then you can own higher value investments, not just the bank's interest. Then you can invest however you like, similar to the RRSP, whether you're putting it in stocks, bonds, mutual funds, ETFs, all these different types of investments that are available that can grow way more than the bank's interest that they'll pay you in a high interest savings account, for example. And so if you get really good growth in a TFSA because you're owning higher value investments like stocks or mutual funds, then as that money grows, you're not paying tax. You take the money out, you're not paying tax. You get complete tax-free withdrawal. And so remember, the money you put in was taxed after-tax money. So the only benefit value is if you invest inside the TFSA and that investment grows, because then you get tax-free growth that you can withdraw at any time. All right. So why contribute to a TFSA? Well, it's very flexible. You can use it however you like. You can use it for a savings account at the bank. You can use it to save for your down payment for your house. You can use it for emergency funds, savings. You can use it for any other types of personal savings. Let's say you want to save to buy a car. You want to save for a vacation. And or you can use it for retirement savings and invest in high value, long-term growth investments like stocks, bonds, and mutual funds. Now you have another part of retirement income, but with this one, the TFSA, it's not going to be taxed ever. So that's the great thing about the TFSA, because it's not even considered income when you take it out. And that's an important consideration because at retirement time, some of your retirement benefits are income tested. For example, old age security, which comes from the government. Old age security is income tested during retirement, meaning that if your income is too high, you lose some of your OAS benefits. But if you are taking some of your income from a TFSA, that could be one way to get retirement income and keep yourself under the threshold where you start to lose your OAS benefits. So that's the great thing about the TFSA. One thing though with TFSA is if you are owning stocks or mutual funds, what you might need to know is that foreign investments in your TFSA, for example, US investments in stocks or funds, you may receive dividends from those investments. And if they are from US assets or stocks or fund in types of investments, those dividends are going to have a 15% withholding tax inside your TFSA. Okay, so let's unpack this a little bit. Investment earnings, so let's just take stock, for example. Remember what a stock is. A stock is if you're buying ownership in a publicly traded company. And I'll use an example like Apple. I think many of us know Apple. Apple makes the iPhone. And so if you own Apple stock, because Apple is an American company, basically you have to, if you set up a trading account, you can open a TFSA and invest directly in Apple stock. But here's where the quirk is. Canada and US have tax treaties. And one of these regulations and rules between America and Canada happens to look at what happens if a Canadian owns US assets, meaning stock or a house. But in this example, let's just talk about stock, because you can't own a house in your TFSA. So let's say you own Apple stock in your TFSA. The US tax agency, which is the IRS, they do not recognize our tax-free savings account as a retirement account. And that's the distinction, because in the accounts that the US tax agency recognizes as retirement accounts in Canada, so RRSPs, and then when you convert your RRSP to a RIF, pension accounts, you are allowed to hold US stocks in those accounts and you don't get this 15% withholding tax penalty. However, they don't recognize the TFSA as a retirement account. And so if you own US stocks, or if you own mutual funds that also are then owning underlying US assets, then you have this 15% withholding tax on the dividend income. So you might not really notice this. I would say that it's not really going to be a huge deal for you, because for the most part, if you do have like a stock account or a mutual fund account, you have set it up so that any dividends you get automatically reinvested back into that account and go back into buying more of that investment. So it's like what we call a dividend reinvestment plan, a DRIP. And so you don't even really notice it, because it's not like you get that dividend as income. It just goes back towards buying more of the stock. So what the 15% withholding tax is going to do is that you're going to have slightly less that gets reinvested in your account than you otherwise would. So it's just with the dividends, because again, if you have profit, if you have capital growth, capital gains, that is not taxable. So you take that out of your TFSA and you don't pay tax. It's only the dividends that get this 15% withholding tax. So, practically what are you going to do? Probably not a whole lot about it. It's like I said, 15%, it's not going to be a ton of money. If you're like a tax purist and you really want to, maximize tax efficiency to the utmost amount, then you would structure your savings accounts and your investments such that you do not own anything that has underlying US exposure in your TFSA. You can do that in your RSP, but you would not do that in your TFSA. You would only use your TFSA for example, Canadian investments. So you can buy all types of Canadian stocks and mutual funds, that are investing in Canadian companies only, and not have to worry about that. But if you don't, I would say it's not really going to be that big of a deal to you. Just know that some of your dividends being reinvested will be going back towards the IRS instead of going back into your account. So what about beneficiary designations? So when it comes to naming a beneficiary, your TFSA, you have two options. Number one is you have what's called a successor holder beneficiary. And if you have a spouse or a common law partner and you name them as the successor holder beneficiary, when you pass, all the money in the TFSA and the TFSA box itself gets passed to your surviving spouse or partner. And this is significant because, number one, there's no tax implications or considerations, and they just inherit your TFSA. In fact, if they have their own TFSA, and let's say they've maxed out their contributions, they still inherit your TFSA. So irregardless of whether they have available contribution room in their own TFSA, they get your TFSA when you pass away. That's the real power of having the successor holder beneficiary. So it really allows for the continued tax-free growth of the investments within the box for the beneficiary. Option 2 is a regular beneficiary, which can be any, organization, charity, any individual. And so when you pass, all the money in the TFSA comes out of the box and goes to the beneficiary. So basically they get the cash, they get the money, they don't get the whole box. And so that's significant because number one, there's no tax implications, it's tax-free still, but when they get that cash, if they want to save it in their TFSA, it's a contribution for them, which means they have to have available contribution room. So that's the distinction. Both options will still see money pass directly to the beneficiaries and will not be subject to taxes, will not be subject to probate as an estate function. And so that's something important to know. It's just the difference between the spouse or the common law as a successor holder being able to roll it right into their TFSA and any other normal beneficiary not being able to do that unless they have available room. Let's also talk about creditor protection from bankruptcy. Creditor protection from bankruptcy is really strong for retirement assets like an RRSP or a RIF, also pension savings. So with those accounts, it's good to make sure that you name a beneficiary also, so that it also goes directly to those individuals and avoids probate fees and all those other types of things. Now, with the TFSA and non-registered savings, there's little creditor protection, except in Quebec. So with the creditor protection, this is a provincial thing, and the rules can be different across the provinces. Typically though, with retirement savings, like an RSP or RIF, really good and strong creditor protections in a bankruptcy, whereas the TFSA typically does not have the same type of strong creditor protection during a bankruptcy, except in Quebec. Quebec is the exception. All right, so now let's look at comparing the two, and we'll start by comparing the popularity of the two. And let's look at the RSP first. So comparing 2008 to 2018 and looking at all of the tax filers who contributed to an RSP by age group, you can see that across the board, pretty much the popularity of the RSP went down between 2008 and 2018. The one exception is the 65 and over age category. Now with the TFSA, and it's like the opposite. From 2009, which is when the TFSA was introduced, to 2018, you can look and see that for every age group, the TFSA has grown in popularity. I'm going to highlight the under 25 because you can see a massive difference there, in TFSA use versus RSPs. And overall, I think that's gone into contributing significantly towards this distinction that we see, where the RSP has kind of gone down in popularity, where the TFSA has gone up significantly. All right, so again, comparing the two, what you have are the ability to contribute to the TFSA and RSP. Remember, you have limited contribution room for either. But what you're putting into the TFSA is after-tax dollars, and you don't get an offsetting tax deduction. With an RSP, you can put in tax dollars and you get a tax deduction, which might give you a tax refund. And then my suggestion to you is that you should save your refund as well. The maximum contribution in the TFSA this year is $6,000, but you have carry forward from unused years. If you haven't used them up, you can carry them forward. And with an RSP, your maximum contribution is based on your last year's earnings, using that formula that we talked about. However, in a similar way, you can carry forward any unused RSP contribution room as well. If you are investing the money in your TFSA and investing the money in your RSP, while the investments in the TFSA are growing tax deferred, essentially it's tax-free because when you take the money out, you don't pay taxes. Whereas within an RSP, the investments are growing tax deferred, meaning that you pay the taxes when you make a withdrawal. And with your withdrawals from a TFSA, you can reinstate those withdrawals in the next year. So let me explain that a little bit better. When you take money out of a TFSA, you can you get reinstated contribution room for the amount of that withdrawal starting in January 1st of the next calendar year. So I'll use an example. Let's say you have $30,000 in your TFSA and you take $10,000 out. And you take $10,000 out, maybe you're going to buy a used car. In the end, you didn't buy it, so you think, okay, let me put this 10K that I took out of my TFSA, let me put it back in. The problem, though, is that it's counted as a new contribution if you're doing this within the same year that you took the money out. It's counted as a new contribution. If you have available contribution room, then you're okay. If you don't, because you're maxed out, then you might now be in a penalty situation and you have to pay penalty taxes. And so that's why you want to, when you take money out of a TFSA, if you're not sure that you have the available TFSA contribution room to put it back in, don't put it back in until the next calendar year, because then your contribution room will be reinstated by the amount that you withdrew, plus it's a new year, your new annual contribution room amount. That's the TFSA. Now that's different with an RSP. Whatever you take out of an RSP, you can't reinstate in contribution room. It's just gone forever. Okay, so let's play this fun game. We're gonna go line by line, and so while you're doing this with us, see if you can guess with each one what the right answer is. Is it going to be TFSA? Is it going to be RSP? Or is it going to be both? So let's start with in high income years. When you are in your highest income year, so think about the marginal tax rate within your province that you're in. If you're in sort of the top 2 marginal tax rates in that area, then you really should be focusing on maximizing what? TFSA or RSP? RSP. RSP, okay? You can just do this in your head. I'm not gonna call on people. Do this in the head and see how many you get right, okay? So in your highest income years, especially anybody who is considered higher income, meaning that let's say you're in the top 2 tax brackets within your province in terms of marginal tax rates. Definitely you wanna be focusing on the RSP, because the value of your tax deduction at that highest, at those high tax brackets is really significant. And so, whereas with the TFSA, you don't get a tax deduction when you put money in. Now, let's look at the next one. In lower income years. So let's say you are not in the highest top two tax brackets. Maybe you're in the, end up in the middle, or you could be low income. Then what should you do, okay? And the answer is you should focus on a TFSA. So this could be the case if you, let's say you left the workforce for a year. Let's say you went on leave, for example, and you don't have the type of benefits at your employer that basically keeps your income going for a period of time. So now your income has gone down, and that's a low income year for you, and you want to save still, then you want to focus on a TFSA that year, because you're not going to get the same value of putting money in an RSP and get a big tax deduction when you're in a lower income year. And so in your low income years, maximize TFSA. So that could be someone who's young and early in their career starting out. That could be someone who's just lower income. And that could be someone who is, for a reason why they're, leaving the workforce, or, going on leave, and their income is going to drop for a temporary period of time, then you want to focus on the TFSA. What if you need to withdraw money before retirement? So you need to take money out before retirement for any given reason. Let's say it's an emergency and you need to take money out of your savings. Which situation would be ideal to, let me phrase this better. If you anticipate needing to withdraw money before retirement for whatever reason, let's say you think you're going to be having to care for an elderly parent or a partner or spouse. And, anyone who's ever done that knows that there are some out-of-pocket expenses that come with that. So you anticipate needing to do this, and so you might need to take some money out, maybe even just to make some renovation to your home to allow that individual to have greater mobility in the home. That could be even for you. Should you then be focusing mostly in your TFSA or RRSP, knowing that you're going to take money out before retirement? The answer is TFSA, because again, it's not taxable income. So before retirement, you're still working. If you take money out of an RRSP, that's going to be adding to all your taxable income, whereas with the TFSA, it's not. What about money for a down payment or to go back to school? Because we looked at that example with the RRSP. We saw the two programs that allow you to access money in your RRSP without having to pay taxes. TFSA is also useful for paying for these types of things. Remember, the TFSA is very flexible. You can use it for any type of situation. So the answer here would be both. Both are suitable in that circumstance. Now, what about if you expect to have high income in retirement? If you expect to have high income in retirement, should you be focusing on a TFSA or an RRSP? This is a little different from when we were talking about earlier. When you are contributing, if you are in higher income years, focus on the RRSP. Now we're talking about when you're taking the money out. If you are taking the money out, should you have, and you're expecting to have high income, maybe because you have a really good pension and you're getting maximum from Canada Pension Plan and old age security, so you expect your income to still be pretty good. Should you be focusing on saving in a TFSA and an RRSP so that when you're retired and you're taking money out from those accounts, do you want to have it coming from an RRSP that's going to contribute to your high income already, which might put you over the threshold for OAS income tested benefits where you might start to lose your old age security? So the answer is TFSA. If you expect to have high income in retirement, then you should be saving primarily in a TFSA so that when you take that money out, it doesn't contribute to your higher taxable income. Now, if you need to save more than $6,000 per year, well, I would say you can focus on both. Try and maximize both if you can, if you have the ability and the means to. And then again, if you had no income last year, you know, I use the example of maybe you went on leave, for example, then TFSA is the one to use. All right, so poll number 2, what savings account will you prioritize? Are you going to prioritize an RRSP, a TFSA, both, or neither? Maybe your goal and sole focus this year with high interest rates on debt is to focus on paying down debt and you're going to take a pause on focusing on saving. What do you think? So you can answer multiple responses with this poll. So you can choose more than one, select more than one option. All right, about 50% of you have participated, 75% now. So let's end the poll, share the results. And it looks like half of you selected both. You're going to focus on the RRSP and the TFSA. And then the next most common response was the TFSA solely, followed by the RRSP solely. All right, very good. We like using these polls just to add a little bit of engagement. We are in a virtual setting, so not having the face-to-face engagement, we want to try and add some ways for you to participate. So key takeaways. You want to know the difference between average and marginal tax rates. For one, because marginal tax rates will help you start to calculate the value of tax deductions. Find out your available RRSP and TFSA contribution room. It is up to you. Your financial institution is not in charge of that. It's up to you to know how much available room you have in each so that you don't over contribute. And you can do that by looking at your notice of assessment when you get your income tax return. You can sign up for a CRA My Account, and then you can log in anytime and see your available room. Or you can call the CRA tips line at 1-800-267-6999. Save as much as you can in both and maximize both if you can. But you know, refer back to our chart if in certain circumstances you want to optimize which account to use. And then identify then what account is optimal for that circumstance. So again, this has been recorded, so it will be posted up on the Oasis website around next week this time so that you can refer to it anytime that you want.